Yeah, we've got an interesting week here, so wanted to bring up a topic that's close to all of our hearts. Why are central bank meetings important? And especially for traders that are engaged in stock market, mainly stocks or options. Central banks, the FOMC, can have some weight to it. But why does this matter for currency traders a lot more? And why do they watch central bank meetings outside of the U.S. And in other regions? First things first, monetary policy decisions. The U.S. central bank will meet 8 times a year to set the overnight federal funds rate, which we're seeing here on the right. That's really the headline of a lot of these meetings. Biggest talking points is Fed rate cuts, Fed rate hikes, and that has a direct impact on currencies because that is, at the flip of a switch, direct impact to the yields, the return for holding some of these currencies. And then at these meetings, they set a slew of other things like quantitative easing, tightening, and a lot more down the rabbit hole metrics to try and fulfill their dual mandate of keeping countries' monetary policy in order. But the quantitative easing piece, you tend to see when it's kind of out of proportion, like you'll look at the balance sheet of the Bank of Japan, and that's something where you can kind of directly tie. They don't have that under control, and that's a large part to the supply and demand, and a lot behind the Japanese yen weakening. But I know that doesn't interest you as much because all of this stuff pretty priced in by the time we get to these meetings, because they can have such an impact on currency markets and across asset classes. A lot of central banks do their best to telegraph these moves, and that takes us to what else they talk about, their economic assessment and outlook. And this,
I see a hat, a very skinny snowman, Frank in a kimono,
Yep.
and then an alien.
Read the tea leaves,
Yes.
because that is the best you can do when the Fed releases interest rate projections for the next 3 years. Who knows? Once you get to that longer run, what they'll actually be. But this is released at the same time as the meetings, an economic summary, and this is scrutinized immediately. Where is the trajectory looking? It's all forward-looking, and any traders or market participants do their best to try and get ahead of how that narrative is changing. And they'll release a 17-page document. You can read as much as you want, but it really is up to the market.
Please, God, don't read it.
As to what they pick is and what they deem is important. And moving on to the press conference, forward guidance. This in the U.S., and it's pretty standard across the world.
Right.
You'll get the meeting. You'll get the release of all the economic data they've put together, their statement, but then it'll be 30 minutes later they'll hold a press conference where they draw out some of this stuff is released, but then they'll take questions, and that's where you can kind of gauge if you hear hawkish or dovish. That kind of granularity can really move markets, as the whole game behind this is trying to predict where central banks will go next with their monetary policy decisions. But that just gets me to some of these takeaways for traders, and be curious to get your input on this. But really, you can read into a lot of this stuff as much as you'd like to, but there's opportunity no matter how in the weeds you get, just understanding what all the parts there is around these decisions. This Eurodollar graph from the December Fed meeting I think is really interesting,
right,
because we're looking at the 15-minute candle here, and you can see right there at 2 o'clock.
4 euro. Yeah, that's a long time ago.
And and so we had the snap announcement. We had a large move, outsized move to the downside. Then you have that 15 minutes between the initial reaction and the press conference where you can see a little stabilization, and then the press conference really taking the pair to new lows. And so it really is just understanding, is there a surprise in this announcement? Where was everyone expecting this to be? Are there differences from that? And then longer term, you have the interest rate differentials play into this, where you'll see kind of more long-term moves like you've seen in the dollar yen, where you can expect this interest rate differential to be wide for a long period of time. So you get more institutional bets and money behind some of those carry trade strategies that can exacerbate a lot of these moves.
Absolutely.
How's that?
And it's a great walkthrough. And I think you hit on, if you like taking the watch apart, so to speak, this is great. You could dive into this. For a trader, those 16 pages they publish, the market will digest that and show you exactly in literally less than a second
Insane.
what the summary of that document said. I like to rely on the market versus reading the paper. Context is great. I think the dot plots show these guys have no clue. And it's a hard thing to do to guess
absolutely.
where a rate's going to be in 12 months. But for us, as traders, the takeaway is sometimes you don't know when the tweet's coming. And the tweet can either make you feel really good or really hurt, depending on your position. That's unknown. This is a known unknown, which means I know at 1 o'clock something's going to come out. And at 1:30, they're going to come out and say something again. That's going to give me 2 windows of opportunity to start thinking about widening my expectations, because we know there can be, in this example, it's perfect, more elasticity. Don't try to guess what they're going to say, because if I've seen this happen so many times, if I handed you an envelope and said, this is what they're going to say, and you go, wow, that's really bearish. And I told you, you can trade this, but you can't close that position until the end of the day.
It's still
really hard. So
yeah.
You want to take from this is that, again, we've got Bank of Canada today,
Yep.
ECB tomorrow.
Yep.
Those are 2 inflection points where I'm going to widen out my levels of interest. I'm going to think about what I want to manage going into the meeting and if I still like my bias. And then I'm going to look for opportunities on both sides. And this is where you want to, again, Canada's had a good run. We know Euro's had a tremendous run. I want to think about, if they really beat up Euro, where do I want to buy? And it's like, well, I don't want to buy until they get back to 104 because that's as cheap as they were. That's not a reasonable thing.
Right.
Within the range, what's an extreme you'd be interested in trading this level? So this is all great takeaways for us in terms of context, and you can dive as deep as you want, but the market's wonderfully efficient in telling you that.
It is.
And it's for us to take advantage of the fact that you're going to do your homework, pick your levels, get set. Now, probably 3 times out of 10, nothing really happens.
Exactly.
All right, you pull the orders out, you move on to trading. But when they do, you get an opportunity to either harvest some profits on a run or establish a position. The management piece is critical because you can have loss metrics that you're not going to be able to get at because the market's going to move quickly.
Right.
So it's being mindful that I'm going to have controllable size that may move a little bit further against me than I would have wished, and the ability to, like, if that size is small enough and it does move, you can make the decision like, okay, at this value point, I'm going to defend that with a little bit of cost basis reduction. All great stuff around context. Why these meetings are important, tradable opportunity at the end of the day.